Thank you for being here today. What if I told you that the record breaking stock market isn't a sign of a healthy economy, but a symptom of a hidden crisis? What if the very forces that seem to be driving it to new heights are the same ones setting the stage for an unprecedented collapse? Have you ever stopped amidst the noise of financial news and the endless scroll of market tickers to ask yourself a truly fundamental question? Why hasn't the stock market crashed yet? It's a question that seems almost heretical to ask out loud, especially when indices are painting a picture of unprecedented prosperity. By all conventional metrics, by the sober lessons of history, and by the fundamental laws of financial gravity, the market as we know it today should have already fractured and fallen. It should be a ghost of its former self, a cautionary tale whispered among economists. Yet, the opposite has happened. It continues its relentless, almost defiant climb into uncharted territory, shattering records and leaving a trail of bewildered analysts and cautious investors scratching their heads in unison. It feels unnatural, like watching a river flow uphill. This isn't a fluke. It is not a random deviation from the norm. The truth is, there are powerful systemic reasons for this bewildering resilience reasons that operate in the deep financial plumbing of our economy, far from the daily headlines. These are forces that the major banks, financial institutions, and even governments would much rather you didn't fully comprehend, because once you lift the veil and see the machinery at work, the entire game is laid bare. You begin to understand not only why the system is holding together against all odds, but also why it feels as though a much larger, more consequential truth is being deliberately hidden in plain sight. Let's begin our investigation with the most objective evidence we have: the numbers. Numbers, unlike narratives, do not lie. If we employ the valuation metric most favored by Warren Buffett, a tool renowned for its simplicity and historical accuracy, the picture it paints of the current market is not just overvalued, it is completely and utterly insane. This metric, often called the Buffett indicator, compares the total value of all publicly traded companies in a country to the size of that country's economy, its gross domestic product, GDP. Today, the total market capitalization of the United States stock market is hovering around a staggering $66 trillion. At the same time, the GDP of the United States, the sum of all goods and services produced, is approximately $30 trillion. When you divide 66 trillion by 30 trillion, you arrive at a ratio of over 216%. To grasp the enormity of that figure, we need a baseline. Historically, a ratio of 100% is considered the threshold for fair value. Anything significantly above that level signals that the market is overvalued and is entering dangerous territory. To provide a stark historical parallel, let's rewind to the year 1999, the peak of the dot-com bubble. At that time, before the bubble burst with spectacular force, the Buffett indicator reached a then unprecedented high of 115%. What followed was a brutal market collapse, a reckoning that wiped out more than 60% of the market's value and incinerated trillions of dollars in wealth. But look where we are today. The indicator isn't at 115%. It isn't at 150%. It is soaring above 216%. If this single metric were your only guide, you would logically conclude that the market should not just be in a downturn, but in absolute ruins. And yet, here we are, watching it ascend. The distortion becomes even more pronounced when we zoom in from the macro view to the micro level of the market's most influential players. If you analyze the top companies in the S&P 500 and the titans of industry that are responsible for the vast majority of the market's growth, you will discover something even more shocking. The average price to earnings, or P divided by E, ratio for these leading firms is currently around 66. Let's put that number into its proper context. A normal, healthy, and reasonably priced company typically trades at a P divided by E ratio of 15 or 20. This means an investor is willing to pay $15 for every $1 of that company's annual earnings. High growth technology companies, which are expected to grow their earnings rapidly, might command a higher premium, perhaps trading at a P divided by E of 25 or even 30, but a P divided by E ratio of 66 is, by any historical standard, absurd. It signifies that investors are collectively paying $66 for every single dollar of current earnings. Imagine walking into a diner and paying $66 for a hamburger that should only cost $1. It makes absolutely no economic sense. And yet, day after day, people keep buying, pushing these valuations even higher. This leads us to the unavoidable central question of our time. If valuations are completely detached from reality, if every historical precedent screams that a crash is overdue, and if even the world's most successful investor, Warren Buffett, is hoarding cash instead of buying stocks, then why has the crash failed to arrive? Why does the market continue to defy financial gravity? The answer is not simple, but once you piece it together, everything falls into place. To understand the current anomaly, one must first appreciate the natural rhythm of market cycles. Markets breathe. They move in predictable waves of expansion and contraction, driven by human psychology. A cycle typically begins with optimism and excitement. Money flows into the market, pushing prices upward. As the rally continues, euphoria sets in, drawing in more and more retail investors who are afraid of missing out. At some point, the smart money, the seasoned institutional investors, and hedge funds recognizes that prices have become disconnected from their underlying value. They quietly begin to sell their positions, taking profits off the table. Eventually, a catalyst emerges, panic spreads like wildfire, and a crash ensues. After the wreckage is cleared, a new generation of investors steps in at the bottom, buying assets at a steep discount, and the cycle begins anew. This pattern has repeated itself with unwavering regularity throughout financial history, from the tulip mania of the 1600s to the financial crisis of 2008. But today, that timeless pattern appears to be broken. The market is undeniably at a peak, exhibiting all the classic signs of a speculative bubble. However, the big players, the institutional titans, are not dumping everything and running for the exits. While some are exercising caution, many remain firmly in the game. This deviation from the historical script tells us that a powerful, unnatural force is acting upon the system, propping it up from beneath. That force is government spending. The United States government is not merely a participant in the American economy, it is, by an enormous margin, the single biggest spender. Every year, it collects approximately $5 trillion in taxes from individuals and corporations. It then funnels that money back into the economy through a vast network of programs: Social Security for retirees, Medicare for the elderly, a colossal military budget, and increasingly massive payments on its own debt. That money doesn't simply vanish into a bureaucratic void, it ends up directly in the hands of people and businesses. And what do people do when they have more money? They spend it, they buy new iPhones, they eat at restaurants, they fill their cars with gas, they subscribe to streaming services. And where does nearly every dollar of that consumer spending ultimately go? It flows straight back into the revenue streams and profit margins of the biggest corporations in the world, the very same corporations whose stocks dominate the market indices. The intervention, however, doesn't stop there. The truly market-altering force isn't the $5 trillion the government collects and spends, it's the money it spends that it doesn't have. On top of its tax revenue, the government is currently overspending by at least $2 trillion additional dollars each year. It is borrowing this colossal sum from the future to keep today's economic machine running at full throttle. This borrowed money, created out of thin air, follows the same path. It is injected into the system, flows through people's hands, is spent on goods and services, and ultimately lands in the earnings reports of major corporations, further inflating their perceived value and pushing their stock prices higher. This creates a powerful artificial tailwind for the market. So the real question isn't just why the market hasn't crashed. The deeper question is why the government is consciously choosing to overspend by such a historically unprecedented and massive amount. To answer that, you have to zoom out from the economic chart and look at the global chessboard. Since the end of World War II in 1945, the United States has been the architect and guarantor of the global order. It was the undisputed industrial leader, the unchallenged technological innovator, and the dominant financial power. The US dollar was the world's reserve currency, and the US military protected global trade routes. If a nation wanted security, it aligned with the United States and played by its rules. If a corporation wanted access to the global financial system, it played by US rules. If a consumer wanted the best products and the most advanced technology, they bought from companies operating under US rules. For decades, this dominance was so complete that there was no serious challenger on the horizon. Today, that reality is fundamentally changing. The unipolar world is giving way to a multipolar one. Nations like China, India, and a block of other emerging economies are rapidly rising. They are building their own parallel systems, their own advanced militaries, and their own cutting-edge technologies. They are increasingly vocal about their desire to break free from their dependence on the US-led system. This monumental shift in global power dynamics poses a direct threat to America's preeminent position at the top of the hierarchy. In response to this existential challenge, the United States has made a strategic choice, a high stakes gamble. The choice is to spend. The strategy is to spend as much as is deemed necessary, even if it means borrowing astronomical sums from the future and running massive, seemingly reckless deficits. The underlying priority is to do whatever it takes to protect and project its dominance in this new contested world order that is beginning to form. The government operates under the belief that by overspending now, by pushing trillions of dollars of stimulus and investment into its own system, it can outpace its rivals and remain on top until the global dust settles. Now we arrive at the part of the equation that the banks and financial institutions don't want you to fully understand, because it reveals the true nature of the game being played. When a government engages in this level of deficit spending, when it floods the economic system with trillions of newly created borrowed dollars, it inevitably and deliberately creates currency devaluation. Think about it in the simplest possible terms. If an economy contained only $10 in total, each of those dollars would be incredibly valuable. But if the government suddenly printed another $10, bringing the total to 20, each individual dollar would now be worth significantly less. Its purchasing power would be cut in half. That is inflation. That is devaluation. And that is precisely what has been happening by design to the US dollar. This brings us to the hidden engine keeping the stock market from crashing. Investors, especially the large, sophisticated ones, are not just betting on the productivity or innovation of the companies they own. They are making a much more fundamental bet. They are betting on the continued and steady loss of value of the US dollar itself. They understand that as the dollar weakens, the nominal value of everything else priced in dollars must go up. They know that as the dollar devalues, corporations will be able to raise the prices for their goods and services. This, in turn, will lead to a rise in their nominal earnings. It's crucial to understand that this earnings growth is not necessarily because these companies are producing more or innovating better, but simply because the unit of measurement, the dollar, is worth less. This dynamic makes today's insane valuations look far more justified when projected into the future. Consider a simple example. If a company sells a product for $100 today and earns a $10 profit, its earnings are $10. But if widespread inflation pushes that product's price up to $200, the company's nominal earnings could suddenly double to $20, even if absolutely nothing else about its business, its efficiency, or its sales volume has changed. That illusion of growth is the secret fuel keeping the stock market levitating. It is not pure growth. It is not pure innovation. It is a quiet, ongoing, and massive bet on the power of inflation and currency devaluation. This devaluation, however, is not merely a passive byproduct of government spending. It is an actively managed process, and the primary engineer of this process is the Federal Reserve. The government's fiscal policy of massive deficit spending can only be sustained through the active cooperation of the central bank's monetary policy. For over a decade, and particularly since the 2008 financial crisis, the Federal Reserve has engaged in unprecedented interventions to ensure that the cost of borrowing remains artificially low and that liquidity remains abundant. The most powerful tool in this arsenal has been quantitative easing, QE. In simple terms, QE is a process where the central bank creates new money digitally and uses it to buy financial assets, primarily government bonds, from commercial banks. This has a twofold effect. First, it injects trillions of dollars of new liquidity directly into the financial system. Second, by creating immense demand for government bonds, it pushes their prices up and their yields or interest rates down. This makes it incredibly cheap for the government to continue borrowing those trillions of dollars to fund its deficit spending. The central bank, in essence, becomes the enabler of the government's fiscal profligacy. This sea of newly created money does not stay confined to the banking system. It has to find a home. With interest rates on safe assets like savings accounts and government bonds pinned near zero, savers are punished. Holding cash becomes a losing proposition. This creates a powerful incentive structure that financial analysts call TINA, which stands for there is no alternative. To get any meaningful return on their capital, investors are forced to move further and further out on the risk spectrum. They are pushed out of savings accounts and into bonds, out of bonds and into real estate, and most significantly, of all other assets, and into the stock market. This manufactured desperation for yield creates a constant, relentless bid for stocks, regardless of their underlying valuation. It is a fire hose of capital aimed directly at Wall Street, ensuring that for every seller, there are multiple buyers ready to step in, all thanks to the environment engineered by the central bank. This is the other half of the hidden engine, not just the devaluation from fiscal spending, but the forced speculation created by monetary policy. However, this strategy of propping up the market through currency devaluation creates another enormous and socially corrosive problem, a dramatic and accelerating rise in wealth inequality. The core of the issue lies in a simple question. Who actually owns the stock market? The answer is stark. The top 10% of the American population owns the vast majority of all stocks and financial assets. The bottom 90% of Americans, in comparison, own almost nothing. This creates a dangerous divergence in economic reality as the dollar continuously loses its value and, in response, stock prices climb ever higher, the rich get richer. Their asset portfolios swell in nominal dollar terms, more than compensating for the loss of purchasing power in their currency. For them, inflation is not a crisis, it is a benefit. They do not feel the pain of rising prices in the same way. But for the bottom 90%, the millions of people who live on wages and have no significant investment portfolio, the story is entirely different. They are left further and further behind. Their wages, if they rise at all, rarely keep pace with the true rate of inflation. Meanwhile, the cost of everything they need to live, their groceries, their rent, their gasoline, Their health care becomes more and more expensive. They are caught in a financial vice, squeezed by stagnant real wages on one side and a rising cost of living on the other. The wealth gap, already a chasm, stretches wider and wider with each passing year. This is the uncomfortable truth that banks and financial institutions do not want you to see clearly. They have no incentive to highlight the fact that the market's spectacular rise is being built on a fragile foundation of devalued dollars and deepening social inequality. They want you to keep believing the official narrative that everything is normal, that the growth is real and organic, and that there is nothing fundamentally wrong with the system. But the truth is, the system is being artificially held together by a set of policies that disproportionately benefit a select few, and sooner or later, reality will break through the illusion. Some of the world's most astute and patient investors already know this. They see the end game. Warren Buffett, for instance, is not deploying his firm's capital into this frenzied market. Instead, Berkshire Hathaway is sitting on a massive record breaking pile of cash. He is not doing this because he has run out of ideas. He is doing it because he understands that this game cannot last forever. He knows that when the inevitable correction comes, it will be swift and brutal. He is patiently preparing to use that moment of crisis as a historic buying opportunity, deploying his cash to acquire valuable assets at a tremendous discount, just as he has done masterfully after previous market crashes. He is patient because he knows with absolute certainty that cycles always eventually come back around. So, where does this complex and precarious situation leave you, the individual trying to navigate this strange environment? One thing is certain: you cannot afford to be a passive bystander. You cannot afford to simply sit on the sidelines and hope for the best. If you choose to do nothing, if you simply hold your savings in cash, your money will silently and relentlessly lose its value as the dollar continues its planned devaluation. In this environment, you can act wisely, investing in the right kinds of assets that can protect you from inflation and even grow your wealth. But there is no safe middle ground. In the current financial paradigm, doing nothing is functionally the same as choosing to lose. This is the hidden truth about why the stock market has not crashed yet. It is not a story of organic economic strength. It is a story of a system being deliberately propped up by historic government overspending, fueled by trillions in borrowed money, and engineered through the intentional devaluation of the nation's currency. It is a grand strategy enacted by the world's wealthiest investors and institutions who are playing a long and complex game that most people do not even see is being played. It is a system that works for now, but its internal contradictions make it fundamentally unsustainable. The ultimate question is not if the crash will come, but when. And when it does, those who were prepared, who understood the true mechanics of the system, will be ready. Those who were not, those who believed the illusion, will be the ones who pay the price.